Welcome to Moments with Marianne. This is your host, Marianne Pastana. We're here today with special guest, Nick Nefouse, who's here to share with us when nest eggs need a safety net. So do you have concerns about developing a nest egg, or maybe you're not sure how long your nest egg will last? Well, today's show is just for you. So Nick Nefouse is the Global Head of Retirement Solutions in BlackRock's Multi-Asset Strategies and Solutions team, and head of LifePath, BlackRock's global target date fund franchise, helping millions around the world save and invest for retirement. So welcome to the show, Nick Nefouse.
Thank you.
Well, what an honor it is to have you here to talk about this. Why don't you share a little bit about your background and BlackRock? I'm really intrigued about how this all came together.
Sure. So, my personal background is I run a group at BlackRock called Retirement Solutions. It's our job to focus on what's described as life cycle investing. This is different from what most people think about within asset management, because what most people think about in asset management is about how do I maximize our return. And we try to think about is how you would evolve over time. So how would the investments that you invest in evolve over time? We have to take into account things like how long are you going to work for? What type of job do you have? How long are you going to retire for? Maybe do you want to invest in college savings for children if you have the luxury of being able to do that? So we have to take into account the full life cycle of an individual. And then in my own personal background, I've been at BlackRock now. I think this is my 21st year at BlackRock. So I've been here since I started working. I've been in a series of different jobs. I think it's been 9 jobs over 20 years. And I've been in this current role for about 3.5 years.
Well, what a progression. And it sounds like you know the ins and outs when it comes to the work that you do. What are some of the things when we talk about nest eggs? And I know you mentioned LifePath. Why don't you share a little bit about LifePath with us?
Sure. So what LifePath is, it's what's described as a target date fund. So target date funds, they've been around for about 30 years. BlackRock was actually launched the first target date fund 30 years ago. And the idea of a target date fund is you begin investing it during your working years. And then over time, as you become closer to retirement, the portfolios evolve to go more from a growth portfolio when you're young to more of a spending portfolio as you approach retirement and then go into retirement. So the idea is we take a lot of the guesswork out of investing for individuals. And where most people would see target date funds like LifePath would be in their 401k or similar type plans at 403bs.
So when we talk about target date funds, who is that for? Is this for everybody?
Short answer is yes. Target date funds are for everybody. What target date funds are, at the simplest sense, is these are diversified portfolios which are professionally managed and generally on the lower cost side because of the amount of competition we have within the market. So whether you are a high income earner, a medium income earner, or just starting off, we think that this is one of the best ways to manage your overall portfolios through time.
So I know you also talk about guaranteed lifetime income. So how does that play a role in all of this?
It's a great question. And this has been a question that's come up a lot more in the last number of years, given the amount of people approaching retirement. And this is just the demographic changes that we're seeing in the US. Some of the numbers get thrown out are something like 10,000 Americans are retiring every day in the United States. So it's an enormous amount of people. So it's putting a lot more focus on this. When we think about guaranteed income, a lot of times people want to immediately think about something like an annuity. And what I always try to talk to people about first is Social Security, because Social Security is guaranteed income. So we all have a form of guaranteed income, and Social Security is very popular. What we've also seen is people who buy other forms of guaranteed income or have access to other forms of guaranteed income. This could be a pension plan, or it could be some sort of insurance product like an annuity, tend to be happier in retirement. They also tend to spend more money in retirement. There's a couple of behavioral reasons why we think that happens. But overall, what we're trying to figure out is how do we make individuals' 401k plans look more like these traditional pension plans, where you did see the levels of guaranteed income in the portfolios. So we think of this as Social Security as forming the foundation. And then on top of that, can we get an additional source of guaranteed income to provide more certainty in retirement while still leaving access to a large amount of your liquid assets?
I'm sure that many people are thinking that this is very interesting. that they can have this type of product available to them where they may not have other options at other places.
Yeah, the way we built LifePath Paycheck is we really thought about this as three different asset classes that we had to bring together. The first one being Social Security, as I mentioned. The second one being some sort of an insurance contract embedded into a target date fund. And then the third one is the growth portfolios. This is the remaining liquid assets. And we have to think about how do we build a successful retirement based on those three assets and helping people understand really what we describe as institutional quality. So this isn't just about us going out and picking individual assets, but we have to take insurance and turn insurance into an asset class and then embed that into our portfolios and adjust everything else in the portfolios. So with everything I've just said, it's complex. We want to simplify that down into a single target date fund called LifePath Paycheck, where we are going to take care of a lot of that level of complexity, and we're going to take that complexity out of it so an individual can do what they want to do, which is just spend in retirement.
So what typically happens in retirement versus someone using LifePath Paycheck?
What happens in retirement, what we tend to do is there's a number of different things that happen, but what we tend to do, and we've got a couple of papers that have looked at this in the last couple of years, is for those people that get to the point of retirement and want to retire, they tend to retire with what we would describe as a lump sum. So they've saved money. Many of these have invested in target date funds. When they get to retirement, you have a lump sum. But nobody's ever taught them how to convert that lump sum into income. So what we see most people do in retirement is they will live off of Social Security and then any sort of cap gains, dividends, or growth from that lump sum. They don't actually learn how to spend the assets over time. And portfolios, the way we would say this academically is people will anchor to their final account balance and then not want to spend those assets down. What we want to do in LifePath Paycheck is we want to change the conversation. What we want is income to be the new retirement outcome. So everything while you're working at your company and you're investing in LifePath Paycheck, everything is geared around income in retirement. So of course you can find your account balances, but that's not what's important. What's important is the amount of income that your account balance could derive in retirement. And that income is made up of Social Security, the guarantee that we've embedded in the portfolios, and then the rest of the liquid assets. So we're trying to, what we would describe as nudge people into understanding how much their lump sum is worth in terms of annual income.
So when we look at LifePath Paycheck, is it defined as far as the contributions are concerned?
So it is a defined contribution. So this would be in a 401k. And then depending on how the markets move, depending on a number of other factors, that's what would drive your final account balance, which would derive your income in retirement. And what we've done is we've taken what were traditionally illiquid insurance contracts. We've created a new security with two firms. One is Bright House, the other one is Equitable. We've taken that, we've created an asset class around these two insurance contracts, which are liquid. We've embedded them in the portfolio. So from an individual, this just looks and feels like a target date fund. It has the same liquidity of a target date fund, so you can still trade the target date fund daily. But while you're investing in this, we're accumulating these, what we call income units. And then when you get to retirement, if you choose to do it, you can turn those income units into a guaranteed income stream. If you choose not to use it, it just acts like a target date fund. It just felt like you were in a target date fund. You can sell the target date fund and do whatever you'd like to do with your money. There's no commissions or sales charges associated with the insurance contracts.
I think people find that very enticing, being able to get into a product that they don't have commissions and all these things that they have to worry about.
Yeah, we had a question last week when we were talking to some other investors about this, about kind of what was different that BlackRock did. And the way that I frame this, I think is accurate. BlackRock is not an insurance company. So we have to look at the problem differently than the way an insurance company would look at it. BlackRock is an asset manager, which means we have to think about this in terms of asset allocation. So when do I want to buy these insurance contracts? When do I not want to buy these insurance contracts? So that's why everything is built around this idea of it being an asset class embedded into an otherwise diversified portfolio. I think that's what gives us a little bit of a leg up with some of our peers or some of the other products that have been out of the market. These are the products that we have. LifePath Paycheck is really geared as an asset allocation product that's going to help solve a different problem.
Is this something that's available to low income workers as well?
So it's available to anybody who has a 401k plan. To caveat that a little bit further, the way that the 401k plan works, your plan sponsor or your employer would select LifePath Paycheck as your default offering. The strategy is built for 401k plans who can use collective trusts. So anybody that would have access to a collective trust could purchase LifePath Paycheck, and there's some other stipulations in terms of kind of record keeper availability, some more technical things. But whether you're in that plan or not is really what it's described as.
Well, on that note, we're going to pause here for a quick break. We've been speaking with Nick Nefouse, Global Head of Retirement Solutions in BlackRock's Multi-Asset Strategies and Solutions team, and Head of LifePath. We'll be right back after these messages from our sponsors.
Are you a coffee lover who wants to make a difference? Look no further than Fire Department Coffee, a veteran-owned business that gives back to support first responders in need. Each batch of coffee is freshly roasted right here in the USA by a dedicated team of first responders and coffee experts. So when you enjoy a cup of Fire Department coffee, you're not only drinking high-quality coffee, you're supporting members of your community. Start your day with a coffee that gives back. Visit firedepartmentcoffee.com. That's fire, DEPT, coffee.com.
Hey, pay attention, everybody. Amy Vaughn and myself, Dutch Mendenhall, are hosting an event. Have you ever felt like the wealthiest in America play by a different rule book? Even if you earn well, make money, invest wisely, educate yourself, there is an invisible barrier. It separates you from the financial security enjoyed by America's elite. The economic landscape changes every day. The wealthy elite know how to stay ahead of it because we play by a different rule book. At InvestWell Summit, we'll share all the plays, and we're making it to win. Spots are going to sell out fast at InvestWell Summit, so get your butt to investwellsummit.com and secure your seat now.
There comes a moment when you realize you're somewhere special, when you discover that each beautiful creature that you see has been rescued from a life of absolute horror and brought to this incredibly free place. Here's where their lives were forever changed and where yours will as well. Discover over 500 tigers, bears, and lions at the brand new visitor center at the Wild Animal Sanctuary just outside Denver. For more information, visit wildanimalsanctuary.org. Discover true freedom at the Wild Animal Sanctuary.
Internationally recognized and award-winning author Judy Goodman works and teaches outside the box of limited thinking. Working with people from every walk of life, her goal is to empower you to be the best you can be, no matter what the challenge is. Born with the gift of seeing beyond our normal vision, she has an extraordinary gift of working with every challenge. Teaching beyond conventional wisdom, her work is described as life-changing. Visit judygoodman.com. That's judygoodman.com.
I'd like to thank Jason Eastwood at Guitarfulness for sharing his inspiring music and talent with us. His music is known worldwide for cultivating atmospheres of harmony, inner peace, and clarity. Visit Jason's website at guitarfulness.com. Join his newsletter, be part of his community, and download his music. Welcome back to Moments with Marianne. We're here today with special guest, Nick Nefouse, who's here to share with us when nest eggs need a safety net. Now, do you have age brackets that people can start using these products?
So the way that all target date funds are built is we build them around the year in which you're going to retire. So for those people that are in their 20s or 30s right now, we don't think it's very important to buy insurance contracts at those ages. So you would just still buy LifePath Paycheck. It's asset allocation. There's stocks and bonds in these portfolios, but we don't buy the insurance contracts until you get older. Now, the good news is for that person that's 20 or 30 years old, they don't have to do anything. So just like we don't ask that individual, what percent of the portfolio do you want to have in small cap stocks? And when do you want to buy those small cap stocks? That's our job to do that for them. We're not going to ask this individual when to start buying insurance contracts. We view that's our job as well. And because we're not an insurance company, there's really no incentive for us to buy insurance when we don't think it's most appropriate for you. So to answer your question a little bit differently, around the age of 55 is when we start buying these insurance contracts. We begin dollar cost averaging into them at age 55. And then by age 65, about 30% of the overall portfolio is invested in these insurance contracts. Now, again, if If you get to the point of retirement and you don't want these contracts, it's not a big deal. You can liquidate the fund and take your assets elsewhere. There's no commissions or sales charges to do that. If you decide you do want these insurance contracts, we've showed you along the way how much they're worth. If you do select to annuitize, that's when this would become illiquid, if you choose to do that. But again, there's no commissions or sales charges associated with this.
So, for young people out there who might not be thinking about retirement, what are some ways that they can start to create a healthy nest egg?
So I'll take this in two different ways. If you have access to a 401k, it's very important that you at least invest up to your match. So most companies will have a matching contribution. Usually it'll be something like for 50 cents on the dollar up to a certain limit. You want to make sure you're saving, and you're saving up to the match, because that match is really free money that your firm will give you. Buy the target date fund and then just leave it alone. Don't look at it. You don't need to trade it at all. These are very long horizon assets. So that's the first thing that I would tell you. If you don't have access to a 401k plan, and unfortunately about 50% of Americans don't have access to a 401k plan, and we launched a product simply called LifePath ETFs. So if you like what you're hearing, you can always look at our LifePath ETF range. These are very low cost. These range from about 8 to 11 basis points in terms of fees. You can buy those associated with the year in which you're going to retire. So if you don't have access to a 401k plan, it can get a little bit harder, but we tried to make it easier. So you can access this great institutional quality portfolios that we create, but you can buy them through an ETF wrapper. So you could buy that on a brokerage, as opposed to what we're doing in LifePath Paycheck, which is only available in 401k plans.
So, for those people that are listening to this and think this is a great idea, but maybe they need a little bit more help, does BlackRock provide education?
So there's a lot of education on our website. So if you are not able to buy LifePath Paycheck, and to be clear here, LifePath Paycheck is the product that we have, which has the insurance contracts embedded in it. It's the only product we have with the insurance contracts embedded into it. That product has a whole educational suite built around it digitally that will be integrated into the benefit systems. If you're not able to access LifePath Paycheck, that's where you can go to our website. We have a huge amount of resources on our website around retirement. So there's different retirement calculators. One of my favorite, it's called the LifePath spending tool for those people, not the younger ones, but the older ones that are just trying to figure out how much money is my account balance worth in terms of dollars per year. We created something called the LifePath spending tool. The LifePath spending tool simply asks you, how old are you and how much money do you have? And from there, we use longevity tables and we use capital market assumptions to figure out how much money is a conservative spending for you for the rest of your life. This goes back to the point we made earlier. For those of you that don't have access to the 401k plan, we want to be able to provide something for you with the LifePath ETFs. Now, again, those don't have the insurance contracts in them, but it allows you to get going on retirement savings using the same philosophy that we have across all of our portfolios.
So, how do these products help people who are high income earners? Is there a different strategy for them?
So the way the strategy works is it doesn't really matter whether you're where you are in the income threshold. And the reason for that is the way that a target date fund works, goes into a little bit more details than the earlier answer that I gave you, is what we're looking at is how an individual earns money over a lifetime. It's not that you, when you get closer to retirement, you're taking less risk. What actually happens is you have less years of earnings. So there's a concept that you'll hear if you talk to somebody about target date funds long enough called human capital. So human capital is how we all earn money over a lifetime. Human capital is hump shaped. So we start earning when we're in our early 20s, not very well. We hit our peak earnings in our late 40s or early 50s. And then it starts to decline as you get closer to the age of about 65. And it doesn't decline because our skills are bad. It declines because we tend to work less hours. We tend to do less things like go back to school, go back to a trade school, maybe move across the country for a new job. We tend not to do that in our 40s and 50s, where we tend to do that a lot in our 20s and 30s. So whether you're a high earner, if you have high human capital or medium human capital, what we're really looking at over time are the ratios. So to say this differently, if you're a high earner, you really have to save more money than if you're a middle earner to replace your level of spending in retirement that you had during your working years.
So, I understand there's been a lot of research that's been done in regards to LifePath Paycheck. So, what are some of the key findings?
There's so many ways I could take this amount of work that we've done in the last 5 years. But the one of the key findings that we've done, there's a recent paper that we published, and what we looked at were really across any of the income thresholds. We wanted to look at different personas, and the real question that we were asked was, well, how much of an impact will this have? And what we found was, if you save for retirement, as we would recommend you save for retirement, you get to the point of retirement and then you annuitize, the average lift in retirement income was about 22% across the different personas that we looked at. What this basically says is that if you buy a guarantee, the presence of that guarantee allows you to spend more money for a number of different reasons. But we found it was significantly higher than we originally anticipated, the punchline being about 22% higher.
I think those are some really interesting stats, how that all comes together. And so what do you see going forward with this product? How do you see this helping people?
When we think about target date funds, the way that I at least think about these is you tend to be focused on those Americans that likely won't have access to financial advice. So we always pride ourselves on trying to provide the highest quality solutions for these individuals, where we can try to help them get to that point of retirement. What's changing now is we're going to help them get through retirement as well with a product like LifePath Paycheck. I think what you're going to see, and if you read Larry Fink's letter in our CEO's letter earlier in the year, he talks about LifePath Paycheck changing retirement. And I genuinely believe that. That's why we've taken on this project. It's taken as many years as it has. Now that we're taking on this, you're going to see more products come to market that are going to be forced to integrate insurance into otherwise asset allocation portfolios, or other portfolios that otherwise would use stocks and bonds in their allocation. So I think you're going to see a big wave of product development coming on the back of this, which is going to be great for the individual consumer. If I go back about 15 or 17 years to really the big explosion that we saw in target date funds was in 2006. What you saw happen was a fairly obscure act called the Pension Protection Act, PPA, as we know it in the industry. What PPA did is it created this ecosystem within the U.S. retirement market, which basically did a couple of things. It created what are called auto features, so auto enrollment and auto escalation. It created something called the QDIA, the Qualified Investment Default Alternative. And by doing that, what this allowed us to do is to have people automatically enrolled in 401k plans. We could automatically escalate, so increase the amount of savings per year. And what the QDIA allowed us to do is to not have the money defaulted into a short-term bond fund. The QDIA could be the target date fund. So the combination of these auto features, which solved a lot of the behavioral problems, and the qualified default being the target date fund, what this did is it led to significantly better savings outcomes over the last 15 or 17 years. You see significantly better balances across all age cohorts. We're seeing more money go into these plans. The reason why I tell you this story is I think you're going to see the same thing happen over the next 15 or 17 years. And what you're going to see are more products like LifePath Paycheck coming out. More people are going to say, I'm going to retire with my target date fund because my target date fund allows me to do this. So just like it took us, I don't think it really took us 15 years, but over the last 15 or so years, you've seen this growth in target date funds till they're now pushing $4 trillion in total assets in the US. But very few assets are in the retirement vintages of these funds because people hold them into retirement. What I think you're going to see is a similar change on the spending side, where you're going to see more people staying in these portfolios. You're going to see more people using these portfolios because we can access these institutional quality tools.
I appreciate you taking the time to go through that and share that with us. And correct me if I'm wrong, I was so blown away by the stats of how many workers believe that they can have enough income for retirement. I think it was like 21%, something like that.
Yeah.
And it just blows me away when we think about retirement. Most people don't think they can.
Yeah, and that's something that always worries us as well. And I think there are little steps that we can take to have better retirements. And I think that's what we have to start educating people, because I always think of retirement like fitness or health. It's making little good decisions every day. It's not a big bang approach. It's not that you decide to start eating healthy one day or you start to work out one day. It's about eating healthy, a little bit healthier every day, working out a little bit every day. I always think of it as like the 10,000 steps problem. We always think about 10,000 steps as kind of the minimum that you need. It's probably not quite 10,000, but it's 10,000 steps to be healthy. There's those little things you can do, like we described earlier. Can you save just enough up to your company's match? Leave that money in the portfolio. Make those little decisions every day to help driving better outcomes over the very long term.
Well, Nick, where can people get started with BlackRock? How did they move forward?
The best thing to do is to look at our website. And as I've said a couple of times, if you simply Google search the LifePath ETFs, for those people that really are looking for not only some education, but as well as if you do want to take that real step of investing for retirement, to me, that's your best bet. That'll take you to our website, and you can look and see many of the research papers, the tools, but more importantly, just the simplicity of what we're trying to talk about.
And from there, they can reach out to somebody and get started, right?
Absolutely.
Well, Nick, thank you so much for taking the time to be on the show with us here today.
Thank you.
Well, thank you, Nick. It's been such an honor to spend this time with you and to talk about BlackRock's new LifePath Paycheck and when our nest eggs need a safety net. Well, we're at the end of our time today. I'd like to thank everyone for tuning in. You've been listening to Moments with Marianne, where we make every moment count.
In a single moment, your life can change. Moments with Marianne is a transformative hour that covers an endless array of topics with the best of the best. Her guests are leaders in their fields, ranging from inspirational authors, top industry leaders, and business and spiritual entrepreneurs. Each guest is gifted and a true visionary, a recognized leader in her own work, and while teaching others to develop, refocus, and grow, Marianne will bring the best guest and sometimes a special surprise. Don't miss this. You never know just which moment will change your life forever. Make sure to tune in and visit momentswithmarianne.com for more information.